So our next speaker is going to have to do the fastest whistle-stop tour through his subject. It's a massive subject, it's a massive piece of work, and it's probably best if I do a very, very short introduction to give you as much time as possible to talk, but SBTi is a really important initiative. It's one of the filter options on Fund Eco Market. You can look for companies that support it, and please take the floor.
Cool. Thank you, Julia. It's a wonderful honour to be here today. My name is Uhlenbruch. I'm Financial Institutions Engagement Manager with the Science-Based Targets Initiative. Brilliant agenda structure today. I've been nestled between a session on geopolitics and an upcoming panel session on transition and the role of investors. And just by chance, my presentation is going to cover both. I'm not going to be speaking about defence and weapons, but I am going to be speaking about regional themes, supply chains, resilience, and then pivoting to the role of financial institutions and what role that they can play in the transition. Okay. So a little bit about what we do. We've been around for 10 years. We started off as a partnership initiative among the organisations you can see here at the bottom. In a nutshell, we enable companies and financial institutions to set credible climate change targets for their businesses. We cover real economy world companies and financial institutions. We are now our own organisation. We registered here in the UK last year, so we're standing on our own 2 feet as an organisation. In terms of the impact that would have over 10 years, earlier this year we reached a milestone of 10,000 companies worldwide that have either validated targets or have committed to doing so. So I think it's safe to say that corporate climate target setting, or credible corporate climate target setting, is now mainstream. These numbers are now higher than they were around a month ago. I think we're now north of 12,000 companies, including over 9,000 companies with targets and 2,000 companies with long-term net zero targets. So we've come a long way. In terms of what we offer the real economy, we're moving towards a more modular structure for standards, but in a nutshell, we have something for everybody, no matter where they are in the real economy. So for companies focusing on their Scope 1 and 2 and Scope 3 Category 1 to 14 emissions, we've got you covered with a corporate net zero standard that's currently undergoing a major revision. We're running a second consultation quite soon. We've just published a financial institutions net zero standard that helps organisations and financial institutions cover their Scope 3 Category 15 emissions. I'm sure that everyone in the audience knows that this is where the lion's share of emissions are for financial institutions. They're supported by credible methods and pathways, and we also have sector-specific standards. So if you're a company in steel, cement, power, chemicals, we've got nuanced standards catering for those specific sectors. So it's been a big couple of years. I'll just skip through these slides. Okay, this is a scene-setting slide. It's a bit of a reality check of where we are in terms of progress on global emissions. So if you look at where we've made all the progress in the global north, so here in the UK, across the EU, across other progressive companies, they still account for only a quarter of global emissions. There's a lot of work that needs to be done across the rest of the world, notably across China, which still accounts for 30% of emissions. There's been a lot of reassuring good news today. Some good news here is that China is now the fastest growing country in the world for setting science-based targets. So a lot of potential across Asia. And I'll be coming back to the opportunity in Asia as well throughout the presentation. A lot of emissions still in the original BRICS, ex-China, and also what we call the significant 18 countries that individually have the same share of emissions roughly as the UK. See a red card. Yeah.
Oh, wait for the mic, please, if you would. Sorry, Chris.
Save me shouting. Thanks. I'm Chris Welsford. So I'm just wondering whether you've done that analysis based on per capita data and also taking into account exports of emissions too from the global north to the global south.
I'm not sure, but I'm happy to follow up with you. So come and find me after and we can have a chat about that. But I think the main impression, the whole point of this slide is there's still a lot more work to do across the world. And I think financial institutions have a big role to play in supporting emerging markets on their transition. So coming to some good news, we've heard a lot of noise around the sustainability pushback and anti-ESG movement over the last year and beyond. We've just published what we call a trend tracker report from SBTi. It covers growth in corporate target setting of the last 18 months. And here you can see since 2015, it's been a couple of years to kind of kick off, but since 2021, it's been arguably exponential growth. The 2025 bar is just to mid-year, so we've already overtaken growth from last year. We've had 227% growth in the last 18 months globally. That's good news. Now, when you break this down, which regions are driving this growth? It's Asia. And I think this is quite compelling. We've had the largest growth across Asia. I've already mentioned China as the fastest growing country. What we think is happening here is pressure on supply chains. Now, the beauty of science-based targets is that if you have more than 40% of your total emissions in Scope 3, then you have to set Scope 3 targets. And the most popular target setting method is supplier engagement. So now we're thinking, because supply chains are concentrated in Asia, we're seeing a ripple effect and real traction, and there's a lot more opportunity through here. The only other region I would highlight is North America, where we've had 78% growth in the last 18 months. So let that sink in for a moment. And here's some good news to take away and share that we haven't really seen any rollback. In fact, we've just seen accelerated growth across regions, economies, and sectors. We also looked in this report at the world's largest companies, the world's largest listed companies. We now cover 41% of market cap, so again, mainstream. But what's really interesting is if you look at the revenue to market cap ratio for companies that are involved with SBTi, that tends to be 2.1 times higher compared to companies that aren't involved with SBTi. So investors seem to be rewarding companies that are seen to be taking credible climate action. We're not implying causality, but setting a science-based target is hard. These are usually the companies taking sustainability seriously, that are getting forensic around their inventory, that are looking at energy efficiency and setting themselves up for resilience and future-proofing their businesses. So we thought that was quite striking and speaks to the business case behind sustainability, which is a really big, important theme, especially this year. I'll speed through these. These are some of the reasons that we hear from companies why they set SBTs and some of the values. So energy efficiency, lower costs, that's one. We've talked about supply chains, resilience, competitiveness. We've spoken about Asia and the progress there, so supply chains, another big reason. Resilience comes up, future-proofing against transition risk and regulation. Investor confidence, so one of the two reasons why companies come to SBTi to validate a target, number one is they're hearing it from the procureors, so supply chain pressure, and two, they're hearing it from their financial institutions. So it's become an investor norm, and we think that's quite powerful. And we heard a little bit about transition plans early this morning. There's a strong, positive relationship between having a target as a foundation for building a transition plan. Okay, whoops. I've highlighted two really interesting studies that were published recently that shows how financial institutions are giving either higher valuations or cheaper lending to companies that are taking serious action on sustainability. I won't go through in detail. I think the slides are available. But there's some really powerful examples of European banks giving cheaper lending, around 20 basis points, to companies in high carbon sectors that have credible targets. And sustainability-linked bond issuers tend to see near-term share price increases that are basically double when they're reinforced by having a science-based target. So it's the investors are really walking the walk. Now, I've got a few minutes to introduce, well, it's the only big standard we've published this year at the Science Based Targets Initiative. It's called FINS, the Financial Institutions Net Zero Standard. It's a really huge moment, and this is the segue into transition and hopefully setting up a foundation for the next panel also. So we've already had a near-term target setting criteria for financial institutions. There've only been falling off the cliff, 5 to 10 year targets. We've had 170 financial institutions validate against those. That focuses on lending and investment. But this year we published the first net zero standard, which goes beyond near-term targets. It includes long-term targets as well as other novel areas around policies and governance and transition plans and so forth. So that's just been published. We have over 130 financial institutions that have committed to follow through with setting FINS targets within the next 2 years. And we are keenly anticipating the first financial institution to publish a FINS standard. Maybe one of you in the room may feel inspired and want to be part of the vanguard. So I think it's helpful to explain what goes into a standard, because it takes a real village to publish a standard. I sometimes have the impression it's just chain-smoking analysts, staying up till 3 in the morning, knocking back espressos, but it takes a hell of a lot. So I think 18 months ago, we published the process for setting standards according to SBTi, and they're really robust. So we have to run 2 extensive public consultations. We have to run pilot testing. We did pilot testing with 33 financial institutions last year. We have an expert advisory group that inputs. It has to be signed off by an independent expert technical council, and it has to be adopted by the board. So it's worth noting we've had phenomenal interaction with financial institutions in the development of the standards so that it's both ambitious and adoptable. So some of you might notice that this is the first SBTi standard that focuses on alignment rather than emissions as the primary metric. So I think this is a really big step forward in terms of how this standard is structured. And you'll notice that the leading indicator is the red curve that goes up. That's portfolio climate alignment. So financial institutions need to set near-term and mandatory long-term portfolio alignment targets out to 2050, where they commit to increase the share of climate-aligned financial activities. So that means one of 3 things. It means investing in climate solutions, so technologies that are critical for a transitioned economy, and to also invest in counterparties that are demonstrating that they're in transition. And there's a few really novel ways that financial institutions can use to define whether the counterparties they invest in are in transition or not. So one of the novel features of the FINS standard is, for the first time, it opens up a wider range of third-party alignment metrics and methodology providers that can be used to track progress against these targets. So interoperability is a really big feature of the FINS standard. Financial institutions still need to report and disclose on their emissions. Emissions aren't perfect. We know that there are issues with setting absolute emissions reduction targets. That's why we don't have those. FINS is designed so that financial institutions can increase their emissions in the near term, so long as they're engaging with those counterparties to encourage them to get into transition and in alignment with net zero benchmark. So stewardship has been a theme that's come up again and again and again today, and the way this standard has been designed is to really encourage that and to focus on decarbonisation of the real-world economy and not just paper decarbonisation. So I think that's a really important feature. Financial institutions, they commit to improving the data quality over time so that by 2050 comes, they can make a credible claim about having a net zero aligned portfolio. The other big shift in this framework for financial institutions is that it now covers a wider range of financial activities. 2 minutes? Okay, great. So it goes beyond lending and investing, which is now split out into asset ownership and asset management, because they are a little bit different, and this standard now differentiates for that. But it also includes insurance underwriting and capital markets. So it's the most holistic standard out there for financial institutions, and can be considered a one-stop shop, especially for financial holding companies. So I'm going to try and summarize like a complex 80-page standard in 1 minute. It's essentially a 5-step journey from commitment to undertaking a base year assessment across the portfolio, across a range of indicators. Then there are mandatory near-term targets and long-term targets and policies. And then there are annual reporting requirements and renewal at the end of the 5-year near-term target setting period, after which new targets need to be set. There's a lot there that I don't think I have time to go into, but I'm going to leave these slides with you for your consideration. It's probably worth highlighting that this is the first standard that introduces policies. So there are mandatory policies around fossil fuels. So essentially, it's restricting new financing of fossil fuel expansion with different requirements for coal and oil and gas. Existing investments are okay as long as they're covered with transition targets. So it doesn't mean immediate divestment. It just means slowing down new financing. And yeah, I think I'll leave it there just in the interest of time. But I hope that's given you a flavour of the Fin standard. We've got lots of great resources online. If you've got questions, come around, chat to me. I'll be here all day. And we're looking forward to the next panel around what transition means for investors.
Thank you.
Thanks.
I've given you a really impossible task going through that in 15 minutes. I'm so sorry we had to reduce the session. It's really interesting stuff. I want to know more. I'm thinking maybe like a Teams meeting, maybe at some point, do longer session for those who are interested, or send around a note. I'd love to dig deeper into it, and I suspect others here would also. And we hadn't really had time for questions either. But on that note, can I just ask everyone to thank you? Thank you, Pete, very much. Thank you.